Hi guys, it's Ryan G. Wright with DoHardMoney.com, and I'm coming to you with a Just Ask Ryan question of the day. And today's question is, how do I structure a real estate investment partnership? We're gonna deep dive into this. And if you've got a question of the day, all you've got to do if you want me to answer real estate investing, finance, real estate investing, just type it down in the comments below. And if you're selected, I'll be answering your question as the Just Ask Ryan question of the day. Okay, so let's talk about structuring real estate investment partnerships. A partnership is basically two people or a few people coming together and forming a business. Typically it's an LLC. It could be a sole proprietor, but most times it's an LLC. Now there's formal partnerships and there's informal partnerships. So a formal partnership would be, we start a company and we plan on investing in multiple properties over a long period of time. And more of an informal partnership would be a one-off deal where we're just doing a partnership for one transaction and one transactions only. Both ways, I would put it in writing. Irregardless which way you're planning to do it, I would have it in writing either way. But these principles are going to apply regardless of which way you want to do it. So an informal, formal partnership or a one-off deal partnership versus a long-term partnership, same thing. I would actually look at putting an LLC together, either way, whichever way you're going to do this. And with that, then you can actually put together who's responsible for what. Now, typically with a partnership like this, one person's going to be bringing the money, one person's going to be bringing the credit, and somebody else is going to be bringing the time. A typical partnership is, hey, I'll bring the money and the credit, you bring the work and go find the properties, you manage the rehab crews, and then you come up with some sort of a split. Now, this is how it works. For an investor, you could say, hey, investor, I'll give you what's called a preferred return. And a preferred return is you get some money before anybody else gets money. So the idea is, hey, you can get the first 8% or you can get the first 6% of whatever we get. You're gonna get that before I make anything. And then after you get that, then we'll do some sort of a split. Or you can actually just do a straight up split where you say, hey, you get 50%, I get 50%. Or you can say you get 20% and I get 80%. It just depends on your investor and what they're trying to accomplish. But there's two ways to do this. There's debt and there's equity. Debt means it's a loan. So if you have an investor that comes in with you and he says, gives you say $20,000, that could be known as a debt where you say, great, it's $20,000 and I'm gonna owe you 8% interest on that for however long I have it. They may want monthly payments. They may be okay without monthly payments. Those are things you need to negotiate. The opposite of that is equity. With equity, they put up money. They're the first ones to get paid back. However, if there's not enough money to pay them back, they lose money and you're not in debt to them for the difference. However, you have to keep in mind, they're not going to work with you again. They're the first to be paid, and they could come after you potentially. In a loan situation, they come after you. In a debt or an equity situation, they're buying equity and they get whatever they get. They're the first to get paid, and you lose your time. You lose all of them, all the time and effort and things that you put in the property, whereas the investor just loses his money. Now, typically, if somebody's taking an equity type position, they're wanting to make more money. They're saying, hey, I'm putting a lot into this, I want to get more out of it. Whereas if they're in a debt position, they don't want to make quite as much, but both of those are going to be determined upon risk. Here's what I mean by that. If somebody's putting up a lot of money in a riskier situation, they're going to want to get paid more to get compensated to do that. Whereas if they're putting in money in a safer position, they don't need to get paid quite as much. So you've got to first determine in the partnership, are you looking for debt or are you looking for equity? With debt, you have an obligation to pay them even if the deal goes bad, and they can come after you for that money. With equity, they can't come after you for that money because they're buying whatever they can get. With debt, you're going to pay less but take on the liability. With equity, you're going to pay a lot more with less liability. Now, this doesn't mean an investor isn't going to do their own due diligence. They're going to want to do their own due diligence, say, yes, I'll do this deal, or no, I don't want to do this deal. So they're going to have more autonomy, more power in saying yes or no, which is why they're taking on that risk. You see, investors get paid to take on risk, and the more risk they're going to be able to take on, typically the more money that they'll make. And every investor is going to have a different risk tolerance as to how much risk they actually want to take on. So the first thing in forming this is finding a partner, knowing what you have to bring to the table and what you need. You may need a partner that has great credit. You may need a partner that has good income. You may need a partner that has a lot of money in the bank and is willing to use that. Or you may need a partner that has good credit that will get a line of credit and then use that money, so they're leveraging that money. So there's different things. So number one, what do you need in a partnership? Number two, you've got to decide, are you looking for debt or are you looking for equity? Based upon that, you can make your determination. If you're looking for debt, you can structure the deal that way. If you're looking for equity, you can structure the deal in an equity type position. It just depends on which way you want to have that deal structured, based upon the risks and the rewards that you're looking for. Now, you can do this, like we talked about, on a one-off deal situation, or you can do this on a long-term situation. There could be the situation where you pay preferred returns to the investor, or you could just play a profit split. It depends on what the investor is trying to get out of it. What I'd like to do with an investor is understand their needs and what they want. Do they have money sitting in a bank making nothing? If so, I maybe could pay them a lower interest rate. I can keep more of that, and they're happy and I'm happy as well. All things to take into consideration as we look at these partnerships. If you've enjoyed this video, please hit me with a thumbs up. I would really appreciate it. And if you've got a question of the day you'd like me to answer, type it in the comments below, and I'd be happy to answer that for you. Got a couple other videos I think you should check out. One is relationships to building when getting started. This is how to build relationships when you're just getting started. Another video you should check out is financial freedom through real estate. Now, if you want help with funding a deal, or you want help with financing, or you want help with finding properties, or software, or tools, or resources, or scripts, check us out over at dohardmoney.com. We've got all kinds of helpful tips, tricks, information that can help you along as being or becoming or growing as a real estate investor. Otherwise, make it a very profitable day, and bye for now.